So this clip is just a quick introduction to options pricing. If you're familiar with the topic, you can kind of feel free to skip ahead to the next clip to kind of work out all of this math here. I just want to give a little bit of background on the problem and just to formulate the problem so that it's clear what's actually being solved and for what purpose. Um, there are many financial markets out there, equity markets, credit markets. There are also options trading markets. So options are financial contracts that are being traded, meaning they're being bought and sold, and options are written on top of other financial securities, usually indices, or in this case, I've chosen just some stock. So you have some company, and let's say it goes public. Once a company becomes public, it starts issuing stock. So some big investment firm like Goldman Sachs kind of underwrites, helps a company that's going public issue stock. So if we're all in class together starting a company, and we're maybe we're making chalk or something, and Goldman Sachs will send in its legal team, and they'll value our company, and they'll set sort of an initial stock price. And here, maybe this is a time zero, so this is the time where our company is going public, and Goldman Sachs says, well, we're going to issue your stock and start your IPO at price X, and then as soon as that stock goes on the market, there are sellers and buyers. Where initially the seller, and then there are people buy up the stock and so on, and then maybe around here people realize that maybe chalk was not the best idea for a company, and the stock starts falling in price, and then we kind of crash, and then maybe here someone comes in and buys the company, and we start making something else, like maybe we start making smartphones, and then the price recovers and goes back up, and so on and so forth. And so here I've chosen a particular model for the price where this is not, I guess, would not be standard now. This is a model more akin to your homework, which was proposed back in 1901 by Bachelier. But all it's doing is taking a positive part, meaning that it's preventing the price from going negative, taking the maximum and the number in between those parentheses. And inside there is a standard Brownian motion B multiplied by a volatility. And so that number, the higher it is, the greater the uncertainty about a future, where the future price will lie. And X is, right there is exactly what I marked here. This is our initial price. Once we went IPO, X was the price that our stock started at. And so, when it comes to options, there's a second kind of degree of complexity. First of all, we've issued stock, and that's going to be in some equity market, and people, financial sort of participants will trade, buy and sell the stock, and that kind of helps our company accumulate capital so that we can invest more and either produce more chalk or whatever we're doing. And then when it comes to option pricing, this is going to be a secondary financial contract. So imagine that in addition to this stock, there is also another financial instrument that some other bank has created. Maybe in this case it's I don't know, some other financial institution. They're going to write options at some strike K. So this number K is called a strike. Just think of it as any real number. And this contract is something that you can buy on the financial market. You can also sell it, so it's something that's traded. That's what options markets are all about. And usually, there's many different variations on payoffs, so what they pay at the end. But the idea is that if you buy, this contract for some amount of money, this is what it's going to pay at some terminal time t. So capital T is sort of what's called a maturity time in finance terms. And you can see sort of how the payoff will look like. If our price is above the strike, then we'll actually make some amount of money. There will be a positive payoff. Of course, we don't know how much we paid. You buy the option for something, so that still may not be a lucrative offer. But given a low enough strike K, clearly the payoff will become eventually significant, and then it could be a worthwhile sort of investment opportunity. And then conversely, if the price is kind of dropping, let's say our maturity time was here, and our price was dropping during this time, and maybe K is somewhere, let's say this is our strike price K, and let's say this was our maturity time T. Well, you can kind of see that the difference between the value over the price itself, X capital T, this guy right here, minus something that's larger, and it will be negative, and so the payoff is zero. We don't make any, we don't make anything. So you kind of bought this option to begin with. You spent money to buy it, and then it didn't pay off at all, right? So that's the nature of markets, and there's no need to kind of discuss what all it's for. A lot of it is speculative. A lot of it is sort of for mitigating various risks, and a lot of different sort of applications in risk management and so on and so forth. So no time to discuss here, but hopefully you see sort of what the what the idea is of this options contract. And a big question is sort of what would be a fair price of this contract at time T. So we'll try to kind of go through that, and this is something that you're also hopefully working on in your homework.